Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, November 3rd, and I'm recording this from my office in Purchase, New York. For the U.S. equity market, October ended where the past several months have, near another all-time high. Unfazed by the U.S. government shutdown, the market is focused on encouraging signs. A Fed rate cut, yet another trade de-escalation between the U.S. and China, and a healthy level of upside surprises in the third quarter earnings. All told, the robust bull case continues to remain on track. However, as the S&P 500 approaches a 17% gain this year, the rosy future may be fully priced in. Given how aggressive valuations are currently, the most important question for investors may be, what will be the source of upside surprise from here? To answer that question, investors ordinarily turn to macroeconomic forecasts, but we're at a very unusual starting point. Specifically, asking the question, where are we in the economic cycle, whether early or late, is highly debatable. GDP this year has been powered almost exclusively by only two different but interrelated forces: data center and related capital spending, and a resilient consumer. Decoding this conundrum hinges on the so-called K-shaped economy. Among consumers, the top 40% of households by income now account for 60% of all spending. Those households, in turn, also control about 85% of America's wealth, and two-thirds of that wealth, in turn, is directly tied to the U.S. stock market. Now, consider the same K-shaped dynamics on the corporate side. Within that same stock market that's owned by the richest households, the 10 most valuable companies make up more than 41% of the benchmark index, it too a record high. Market gains depend not only on AI CapEx theme, but specifically on the fortunes of just these 10 companies. While their profits have made headlines across the U.S. economy, profits to GDP overall have been declining for 3 years. Navigating this K-shaped economy will thus be complicated. On the one hand, the dependence of consumption on stock performance suggests that the secular story, not the cyclical one, may be what matters in 2026. In essence, portfolio positioning hinges on whether the CapEx boom will deliver as currently expected. And the odds of that are 50-50 in our view. Specifically, we believe that AI implementation may take longer than many hope, with productivity gains limited to a few scaled companies. On the other hand, lower rates, tax refunds, and deregulation could be powerful stimulus, and the labor market could in fact strengthen, with market gains broadening out. Under this scenario, the Fed may curtail easing if inflation risks rise. Here too, we see mixed odds, because what ails the lower leg of the K is not just rates, but also scale, resources, and access. There is little doubt that the current bull market will be remembered as the great Gen AI boom. However, this may be the point when technology scale and wealth concentration are rewriting the investing handbook and the central bank framework. Therefore, we prefer staying fully invested with maximum active management and portfolio diversification. Consider taking profits in high beta, speculative, and unprofitable equities, as well as in small and micro-cap stocks, while deploying to large cap core and quality names, including the Mag 7 and the Gen AI beneficiaries that we expect in financials, healthcare, and energy. In fixed income, we suggest shifting up in duration to the 5 to 10 year belly of the curve and focusing on asset class diversification. International equities and real assets, including gold, real estate, and select private infrastructure, are also opportunities to add. Thanks as always for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.